Hey guys and girls, welcome to this week's Tuesday Night Live. And have I got a show for you this evening? Yeah, thanks a lot for tuning in. Thanks a lot for having me as a part of your evening. Thanks a lot for having confidence in what I say and wanting to spend your time watching my videos. Today, it could be an hour, it could be in half an hour, it could be 3 hours. Who knows? Let's just have some fun. Um, got lots of cool things to talk about. There's some elephants in the room, really exciting things to talk about, and the end of this cycle that everyone's been fearful of. And probably the biggest thing that I've seen over the last 6 months is a lot of people that are scared, undoubtedly, because you know, interest rates have gone up, their expenses have gone up, their petrol's gone up, their food's gone up, everything's gone up in value, and specifically their mortgage and their cost of holding their debt. And today, I want to talk to you guys about obviously the rate hike today, 25 basis points up. Woo, that's exciting, right? I'm going to tell you why I'm excited. I'm going to tell you what I see for the future. Um, I'm going to tell you what I think is going to happen over the next 6 months tops. I'm going to talk to you about the next rate cut. So everyone's talking about rate hikes and all this sort of stuff. I'm going to be talking to you about a rate cut, and I'm very controversial with the shit that I say, but it's mathematically calculated as to what is possible and what is impossible for the system to withhold. I'm going to go and look at a fly around the world, look at all of other countries and what they're doing, and share with you some of the interesting things that have come across my way and my travels over the course of the last month or week, and yeah, all that. So as I get into it, I can see that a fair few of you guys online. Maybe just give us a like, a little comment to make sure that you can hear me well, and all that sort of stuff, and we'll get straight into it. So this chart here is what I have been talking about for quite some while now. I've been using this chart for a very, very long time. I made a call into Birchfeed on a property forum today, and a few other places, thrown out to a lot of people that have asked me from, my clients, people in lending, as far as, those lenders that I talk about. Um, so yeah, this here is what I have used for a very long time, and it's pretty accurate, but it's only accurate up until about here, right? And all this is irrelevant, but it gives you an indication of the trend line. Something very important happened to this today. I'm going to share with you that. Um, so why did I say that we're going to see a 25 basis point rate hike? Everyone was saying 50 basis points or a 0.5%. I said so because down here on the lower end, I've just printed this off literally as we came online. Um, this here is where the rate is at the moment, which is now 2.52%. And this here says 2.78%. So this morning, this line here had indicated that we would be looking at a 2.6 area, and we're at 2.35. So it only gave us an indication that it would need to go up to that high. And as we can see, it's still over where we are currently. There's a big thing that has occurred just today, like literally just today, just as I printed this off. This here on the top end, so we can see it caps out around here. Hopefully everyone can see that. Yep, it caps out around here. That line, if we bring it across, which it says here RBA official cash rate, says 3.6%, right? You can see it there, 3.6%. Now, up until today, that was sitting at 4%, right? And I said to you guys many, many times that we will see the top end drop down once we get at the top of this cycle. So we've now seen that drop down by about 50 basis points from the top, and we've seen it sort of flatten out. My expectation over the course of the next coming days and weeks, and months, is that this end here will drop off. So this will just completely drop down, and we will see this go negative. So once we start seeing this line go underneath this line, we can start seeing the tide come back, and we'll start seeing rate reductions. Now, all these experts out there that are writing in the media that don't own a property, never earned money, never done anything with their lives, they're sitting there saying, oh well, this is where the RBA is going to be at and all this sort of stuff. It's all bullshit. This is where the real money's flowing, and there's a massive liquidity squeeze, and we're going to see this wave come through like a tsunami and see the interest rates come back down. My prediction for interest rate cuts, and just my calculations, we're right on the eve of that. We may see one more rate hike of a 25 basis point, which would happen in November, which the RBA, I don't believe, meets in December or January from memory. So there's 2 months where they don't meet, which you would see nothing happen to the rates that period of time. And I believe somewhere in that period of the next 3 months, and it could be in a matter of weeks, right? I said to you guys at the start, we would get 6 months before the market shits itself, before this system implodes, and before we start having to see a reversal in the monetary policy. And that's what we've seen today. They can't even keep inflation under track, right? They've hit 2.6% at the official cash rate, and they're out of clutches, right? We're in a recession. Everywhere globally is falling and collapsing and crashing. So very, very interesting to see. We're right on track. I expect to see somewhere between March and definitely by the end of financial year that we will see a rate cut. And look, I'm no financial advisor. This is not financial advice. I don't contribute to financial advice. But what I do say is all those financial advisors out there and those smarty pants that have gone to university and done the right thing and believe in this system, they're all being lied to and feeding you crap anyway. So I'm just telling you from a calculation, right? I have more debt than probably all of you guys watching combined put together. I need to know what's going to happen to these markets. And that's why I get so excited by them. And I look at it and I'm like, I'll take this bet. I will take the bet against the central banks because I know that they are screwed. And I've got lots of cool things to go through today. I'm a little bit sick at the moment. Got a bit of a flu coming on. And I'm in my office in my holiday house. You can see the bricks behind me. And I had nothing to print this out on, so I had to go down. I found a Kmart, this only place that was open. I got myself a printer and printed off a lot of this stuff, all of this stuff that I'm going to share with you tonight. And I'm really excited that I was able to get it in time. So I'm going to leave that here. Not going to throw it off yet because we might have to revert back to that chart. Let's look at this. So why will we see rate cuts? When would rate cuts occur? And what would be the catalyst for the rate cut? So globally around the world, like this here is the Dow Jones. It has had a great day yesterday. It went up like maybe 800 points, which just remembering that the day of the GFC, it fell by 800 points or 777.7 points, which is quite significant of a number there for them. But we've now got the stock market going up and down at 1,000 points in a day, etc. So here we are looking at the stock market here, the Dow Jones. It's now at 29,500, but only 24 hours ago that was 28,200, right? So this point here was about 28,200 or 28,300. At this point here, which is September the 12th, which was 32,381. So over a period from a peak to trough, 32 minus 28, that's 4,000 points. That's about 15% that the stock market dropped in this period to this period. There's 3 weeks. 3 weeks, the stock market dropped almost the whole amount that the stock market was back in 2008, right? In 3 weeks. And no one even cared, right? No one even cared. But why did this occur? Why did this occur? Because there's a liquidity squeeze, right? There's a liquidity squeeze because everyone that's taken on debt, you've got 2-year fixed rates are blocked in, you've got bonds which were purchased, you've got all these things that are now maturing, and the people that have taken on the debt, whether it be governments, whether it be central banks, whether it be large commercial banks, whether it be any business out there, they've all now got this cheap, easy debt that they got their hands onto, and now they're going to have to refinance that, and it's going to be 50 times higher, 20 times higher than what the cash rate was back when they first took it out. So we're now starting to see a global recession occurring. We've been 6 months into that recession. All markets, doesn't matter where you go. I should have actually printed out where all markets were. So if you go and look at your Bitcoin price, if you go and look at your Dow Jones price, if you look at ASX price, if you look at whatever prices there were, probably around the start of this year, the markets all would have started to fall off a cliff. We've been in a recession for 6 months. We've probably got another 6 months left of this before they start really regurgitating money. There's a lot of cool things that are happening out there because people are reading the wrong information. A lot of people are scared. They're just watching the news. They're like, I'm sitting on the sidelines, and I get really humoured by it nowadays. I've been, doing what I do for 20 years. I've been running the B.Invested group of companies now for about 13 years, and 14, I don't know, I'm getting old, getting senile. And people are out there and they're very scared. They're like, I'm going to wait until interest rates stop going up because I'm scared they're going to hit 20%. I'm scared they're going to hit 10%, etc. Where would they stop? I'm going to go broke. And it's understandable. Like if you're stretched and you're, in a world of trouble, I understand it. I get it, right? But if you are just sitting there thinking and watching the news and regurgitating crap that comes out of these so-called experts' mouths, you are literally missing one of the greatest opportunities in a wealth transfer that has occurred in our lifetimes, because the only way for them to get out of the situation that we are in right now, we're going to start seeing something bigger than 2008 occur. And I actually called this going back 6 months ago. If you remember, I laughed and I laughed and I laughed and I laughed when the first interest rates went up. And I said, this is great, right? Because what they're going to have to do is they're going to have to come back and change the course of monetary policy, because it's going to cause so much carnage. It's just, the whole system's going to blow up. And that is starting to happen. I'm going to read through a fair few articles here today, talking about, what's happening out there in the financial markets and what fun things are happening around in the world. Let's just get into it. So this one here, Sydney Morning Herald: dysfunction in this market. The Bank of England intervenes over material risk to the UK economy. Let's go over the UK. Right, everyone's glittered over the fact, oh no, the Queen, the lizard, she died. Right, I wasn't expecting that to happen. She's fucking 96. Right, I heard that witches live for 300 years or so, but who knows, right? Who knows where she is? But God bless her. She's going to need a lot of blessing. So it's here, the Bank of England. This is from Sydney Morning Herald, by the way. The Bank of England has unleashed a dramatic £65 billion. $109 billion bond buying scheme in an attempt to calm its crisis in the government bond markets to prevent the financial turmoil from spreading. The central bank has made the emergency intervention, planning to spend £5 billion a day for the next 13 days, as it warned of material risk to the UK stability and pension markets amid the chaos that has sent government borrowing costs soaring. What does that mean in fucking English, right? In layman's terms, for you and I, not like, I'm a banker and I can put all this shit together. This is saying that the Central Bank of England, the BOE, has come out and they are buying bonds at £5 billion per day, right? Over 14 days. So that is $70 billion in 2 weeks that they're going to buy. $70 billion of stimulus packages. What are they doing with it? They're just buying up assets. They're buying up bonds. They're buying up the stock market. They are pushing the market up. Why are they doing this? Because the market has imploded and it's turned to shit over there. So, and it says here, the Bank of England has been forced to make an emergency intervention, right? They didn't even get interest rates up 2%. Everyone's put their interest rates up 2%, and now their economies are completely and utterly fucked. So what they're going to have to do is they're going to have to reverse the course of monetary policy. And you can see that this chart is very, very flat as they are starting to taper off from their quantitative tightening policy back down to more of an easing. And as I said, this area here, look this up. It's the ASX 30-day interbank cash rate futures implied yield curve. You will see over the course of the next few months, and just remember, guys, I put my credibility on the line every week when I come out with these things, right? I'm not always right. There's things there that, go off course, but I'm 90% on the mark, right? And I think that's why a lot of people like watching what I have to say. Have a look at this, right? This area is going to drop back until about March, right? You won't see it change until probably January, February, something like that. It may happen in October to November. I actually think we are on the eve of a major catastrophe. And I've said that since 6 months ago, and I will keep saying it. And I've got some fun news out there. So now we're seeing the Bank of England. The England market is fucked, the economy is fucked, and they're having to buy every single day £5 billion. The value of the pound has collapsed to record lows against the US dollar, and British bonds have plunged since Friday. The UK Chancellor Kwasi Kwarteng unveiled his mini budget involving a $45 billion of debt financed tax cuts. So they're reducing the taxes over there. The cost of government borrowing has surged. Pension funds have dumped gilts, and households are now braced for big increases in mortgage payments. A gilt is a British pound denominated government debt issued by the British Treasury. Let's just go back a second. Where is it? Oh, give me 2 seconds, guys. That's a good thing about not wearing shoes, right? And having just bare feet all the time. I can use my feet as a little hand, an extra hand, right? This article here, which is the start of what we're reading at the moment, if we go back to the second paragraph that I just remembered, the central bank has made the emergency intervention, planning to spend $5 billion a day, has warned of material risk to UK stability and pension markets. The pension markets. The pension markets. What is happening? What is happening to your super? What is happening to your retirement fund? Everybody's sitting there going, okay, my 401k in America, my super fund here in Australia, it's going to help me through retirement. These guys are literally raping and pillaging that, and that's where you should have control over your own financial freedom instead of sitting there going, okay, whatever the super fund says, etc., etc. It's very, very important, especially in times like now, to make sure that you take control over your super fund. The cost, because your super fund is bought up of all of these toxic bonds, right? Go and find what's in your super fund. It's full of toxic bonds and different types of financial derivatives that's inside of it. If you don't know how much you've got in your super, you don't know what it is exactly invested. If you've got $200,000 on the dot, I want to know where every single dollar of that is invested inside of my super. What is it invested into? If they say it's invested into Australian shares, which shares are they invested into? And I bet you they can't tell you because it's in one big giant Ponzi scheme. And when you go and make yourself a self-managed super fund, you are talked to like a criminal. Why are you taking this out? You shouldn't be taking this out, etc., etc. So just be mindful of that. The cost of the government borrowing has surged. Pension funds have dumped. Oh, we've read that line. The bank has suppressed a program to sell its gilts, part of an effort to get surging inflation under control, and instead pledged to buy long-dated bonds. By buying gilts, potentially in a large amounts, or even just in telegraphing its intent, the bank will push up their price and push down on their yields, which will move inversely to prices. UK government bond markets recovered sharply after the announcement, but the pound fell down 0.8% against the US dollar, so it's 1% of the dollar fell, right? And you start adding these things up day by day, week by week, and you can start seeing that people are going, it's like the musical chairs. The lights turn on, the music stops, and everyone looks down. There's no chair for them to sit on. And this is a time which you will start to see this ramp up greater and greater. If you guys recall, and you've been watching me for a very long time, you'd recall that in March 2020, I did a video talking about hyperinflation. If you haven't seen it or forget about it, go back and watch that. It is on YouTube. I think I filmed it on Facebook Live on a camera in my office with the whiteboard behind it. And I said that we would see the hyperinflation start not before 3 years, but not after 3 years, around a 3 year period. And it will last maybe 6, 7 years tops before the system completely implodes. This next time that they stimulate the economy, they're going to have to throw a lot more at it. For what they've done by trying to stop this inflation cycle, they have caused a problem which has never been seen beforehand to most people. It's happened globally around the world, but it hasn't, happened most of our life. So it's not really the thing. We are heading into hyperinflation. It will be caused from the aftermath of what we're seeing at the moment. So don't get too upset about interest rates. Don't get too upset about what's happening out there. Everything is on track. have a greater plan. There's heaps of people that are little scaredy cats out there at the moment that are like, oh, I'm scared interest rates are going to go up to 10%. My neighbour told me this, my friend told me that, and the TV told me this, and I should go and do this. Make your own decisions based on facts, guys. Um, The new Truss government, not even a month old, has vowed not to reverse its policy, all funded by a huge increase in government borrowing, and has pledged to announce further economic reform soon. So the new government in the UK has come out and they've said that they're not going to reverse what they're doing. They're going to keep printing money. They're going to keep borrowing from the central banks, which what does that mean? That means that the government is now getting into further and further and further debt with the central banks. Just remembering the power structure here, right? If you have to go to someone to borrow from, here's the government here, they're going to a central bank, it means that you're the bitch of the central bank. You are a product of theirs, right? So everyone goes, oh, the government is in control. The government's not in control of shit. The government is being controlled and they are your suppressor. They're the bottom level peasants, right, in the system. So very interesting to see that they have no interest in turning around. That it's only been 6 months and we have seen, tightening rates and all that sort of stuff. And now they have to go out there and create stimulus packages again. Amazing, amazing. A lot of people will be wiped out. Someone said here about getting cash is now time to have cash. I haven't looked at the messages, keep them coming through. Um, the um, the when you see stimulus packages come out this time, the cash is going to lose a lot more of its value. Inflation is not going anywhere. It's just getting started. It is just getting started. Anything apart from cash is what I'd be investing in right now. Debt is an amazing tool because then you've got an asset that you can take through the inflationary cycle and it will go up. And it's not just the debt that will go up, but it's not just the asset that will go up, but the debt stays the same. So you can pay off today's debt with tomorrow's devalued currency, which makes it a lot easier to do so. And you've got an inflated cash flow along the way. The dramatic developments have reopened up deep wounds within the ruling Conservative Party, stricken with the infighting since the oustings of Boris Johnson in July, with the future of Curtin Truss close politically allied now in doubt. In a statement on Wednesday morning UK time, the bank said it would carry out a temporary purchase of long-dated UK government bonds immediately. Where dysfunction in this market continues to worsen, there would be a material risk to the UK financial stability, it said. The purchases will be carried out on whatever scale is necessary to affect this outcome. It added, saying the Treasury would underwrite any losses. The central bank said it had pushed back by a month the start of its plan to reduce the balance sheet by selling its gilts in its portfolio, which was due to begin next week, right? They can't even wind back their position. The International Monetary Fund and ratings agency Moody's ramped up pressure on Britain to reverse a new economic strategy that was rolling financial markets fourth day on Wednesday, and has sparked an alarm about the UK housing market. And a rare intervention in a G7 country from IMF, the global lender of last resort, underscored the severity of the situation facing the country. Given elevated inflation pressures in many countries, including the UK, we do not recommend large and untargeted fiscal packages at this juncture, the IMF said. It is important that fiscal policy does not work at cross purposes to monetary policy. With the cost of borrowing soaring, mortgage lenders pulled hundreds of products, while several media outlets have published anecdotal reports that people were struggling to get through the lenders to change their mortgage deals. Anyway, goes boring stuff there. But what we're seeing is that interest rates have gone up everywhere around the world. Inflation has not stopped at all. We have now seen everything coming to a halt. Every market is seeing bankruptcies, implosions of companies, people losing their jobs, unemployment soaring, all of those sort of things. Very, very interesting times. It doesn't get any better from the other articles I'm going to share with you. So if you didn't forget, this is a news article that's just come out from news.com. Aussies count down to $500 million a month loss. So what is the loss that they are talking about? $500 million is $500 million a month loss. What loss do we talk about? Interest rates going up? Don't worry about that. We're talking about the fuel excise tax, right? In recent months, Australians have experienced some much needed relief from high petrol prices, with an average cost of regular unleaded coming down as much as 48 cents a litre since it peaked back in mid June. But there has been another positive knock on effect driven by Australians to have more cash left in their pockets each month after paying lower fuel costs, increased scope for greater retail spending. People can't spend because they don't have access to liquidity. They don't have access to loans like they did. The cost of the loans are too expensive. People are now paying too much for their food. Inflation is soaring. Wages are soaring for businesses out there. Um, the mortgage cost has gone up from 10 basis points to 260 basis points. So it's gone up 2,600% in the last 6 months. And apparently you've got some money left over to spend. But anyway, in addition to this, spending power may have played a significant role in boosting the nation's retail sales growth to an extremely impressive 16.5% year on year. The chart on retail spending shows. Is this point worth noting that spending on fuel isn't included in the ABS retail sales figures? In some other nations, such as New Zealand and the United States, it is, leaving spending levels static regardless whether or not household spends their cash on fuel or other retail purchases. Based on the most recent survey of motor vehicle usage from the Australian Bureau of Statistics, Australians consume a little over 2.75 billion litres of fuel each month on average. When the fuel was at its most expensive, Australians spent 5.8 billion on filling up in just 1 month. But after prices came back in recent weeks, that figure came down to $4.64 billion, a drop of $1.16 billion per month. To put this in perspective, the most recent month figures, Australians spent 34.7 billion at the national retailers. To what degree falling fuel prices have definitely boosted retail sales is uncertain, but it's not hard to imagine that a significant portion of the windfall Australians have enjoyed due to lower fuel prices have now followed into the tills of the nation's retailers. So when we go on to read this, right, I can go through it for ages. I'm going to throw the thing. I couldn't be bothered reading the rest of it, right? When we go on to read that, the fuel has come down by 25%, right? Artificially, because they took away the tax off it. But then they will, just having a look here, someone here saying that I wouldn't have a clue about interest rates because last time I said they would go negative. They are going negative and they will be coming down very, very shortly. I'll get back to that one in a moment. Looking at the fuel excise tax that's coming out, that's out. When fuel bill has to go up by 25%, that's going to be passed on to the consumer. How does that occur? That means that everything that's being delivered around the country, whether it be petrol for couriers or traveling and all that sort of stuff, that's now going to be passed on. That's a new expense that's going to be passed on via the companies out there. And suddenly it's going to put more pressure on inflation. They cannot control the inflation levels that are out there. Here's the next article. News.com. Fears Australian economy could fall into recession. Looking at this one here. Around the world, the economies of key countries are taking a battering. There are worries that they will drag Australia into tougher times. As I said, guys, if you're watching now, I have a flu. I'm ill at the moment. I am at my holiday house. I thought, who cares about going back to the office? I had to go get a printer. Went down to the shops, picked up a printer, printed off all this, but feeling a bit under the weather. A financial meltdown threatening both the UK and the US could torpedo efforts to ensure Australian economy avoids a recession. However, economists fear, who cares about these economists, they always get it wrong, that the Reserve Bank of Australia also risks plunging the country into recession. Well, we already are in a recession, just no one's talking about it yet, but we'll get to that shortly. We don't have to have all by itself pushing the country into a recession. We don't have to have all by itself if it continues to push through the supersized rate hikes to tackle the worst inflation in 3 decades. The RBA is expected to reveal on Tuesday the 6th rate hike with a predicted 0.5% rise. Here we are today, and it went up by 0.25. taking interest rates from a record low of 0.1% from early in the year to a 9-year high of 2.85. Some have even predicted that rates could go as high as 4.2% in the middle of next year. Well, we can see here that it's not, and it's starting to reverse on the back end of it. Last week, the UK Chancellor, blah, 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 we read through that. The Bank of England was forced to step in and buy government debt, sustain recession. Basically a copy of the other one. Now we are getting into the fun part. So just on that note, right, I noticed that this guy here, Peter, I don't know him at all, said that, made a crack that I didn't get it right because I said that interest rates would go negative. Well, I remember I had trolls on the internet going back 5 years ago when I said that we would see a hyperinflation. I remember having trolls on the internet saying we would see interest rates come down last time, and it was actually February 2019, and the Philip Lowe and all those people that you go and watch and admire and sit in the mum's basement watching, and go, oh, well, this is what's going to happen. Everyone regurgitating shit from the media. They said that interest rates were going to go up. And I was the only person out there calling that interest rates would fall in the June meeting. And they did fall in June 2019. And I said that they'd go down in negative, which they should have, but they didn't because the banks were not designed to be able to cop for a negative interest rate. They have to, and I always said that interest rates would go up. And I said that they'd go up by 0.75%, but not up by more than 0.5%. If they did go up by that, would have a major catastrophe, which is what we're seeing here at the moment. And I think a lot of people are focusing on, oh, interest rates are going up by 2% or 3% or whatever, right? When interest rates come back down in the next 6 months, you'll all be sitting there going, oh, wow, the news got it wrong or whatever happened, right? But what action did you take up along the way, right? Because there's so many people that are fearful, so many people that are shitting bricks out there, and they are not acting in the market. They are dropping their assets and running from the market. So many people were so scared about some shit that came out the other day about the Queensland land tax, right? I haven't talked about that much because I just said I didn't care about it because I knew that it wouldn't get passed. And if it did, I'm not going to be paying it. So looking at, from that perspective, there's ways to get around having to pay the land tax if you really had to. But the thing is that people were so fearful about it and they made decisions based on fear of something that was very temporary. When you take out a mortgage, if your mortgage is over 30 years, that's 360 months worth of interest repayments that you're going to be making to the bank over that 30-year cycle. That's if you don't extend it out or refinance or pull equity or whatever the case might be. Most people are fearful about, interest rates going up this week or whatever the case might be. In 20 years' time, who cares what you're paying? If you bought a house for 100 grand in 1990 and you were paying, 10% for a while, who cares what you're paying? Because what is that asset worth now? What is the cash flow being derived from that? What is the debt level now at that point? So when you're taking out a loan, your interest rate isn't fixed, right, at the rate that it is. Yes, you could have fixed it, but your interest rate that is today will not be the same. Let's say it goes up for the next 6 months. Let's say it hits 5%, right, at the RBA. Let's say it doubles again, which it won't. But let's say it did. That period might only be 6 months, and it might only be 12 months. So it's 12 months out of 360, and people are fearful of making decisions based on that little snapshot of time. But they have to push these rates up because they have to try and control it somehow. But the inflation is greater because they've done so much fraud to the system. I'm going to get onto some more articles about that shortly. But yeah, here is the fun one, right? Here is the fun one. Fears Credit Suisse is on the brink of collapse, right? Who would have thought? Who would have thought? I thought it would have been Deutsche Bank. I've said many, many times that these banks, the amount of derivatives that they had. So, little fun fact of the day. I said this a lot over the years. You may not have remembered. Going back, what caused the GFC back in 2008 was about $7.5 to $8 trillion worth of mortgage-backed securities that imploded. So, collateralized debt obligations. So they were basically mortgages that were packaged and sold as products on top of products. That market is a derivatives market based on mortgages. Since 2008, so what caused the GFC was $7.5 to $8 trillion worth of this billion dollars worth of derivatives. We have now got, between Deutsche Bank and Credit Suisse, reports of $2.8 trillion worth of derivatives. And this isn't just around the property market. If you remember that before 2008, people would happily drive around a 1980s car. But since 2008, everyone's car's disposable. If you see a car more than 10 years old, something's wrong with that. Um, you know, the whole system has changed. These debt items and debt instruments, everything is a debt instrument today. Even the food, when you go and get afterpay for your food. So looking at the system, there used to be $7.5 trillion worth of derivatives, which caused the market to implode. No, sorry. Let's go back. There was $7.5 trillion worth of derivatives. It wasn't billion. It was $7.5 trillion to $8 trillion worth of derivatives, which caused the GFC. Now we've got 2.8 quadrillion, so 2,800 trillion dollars worth of derivatives into institutions. And there's reports out now saying that one of the world's biggest banks insists it is in a strong financial position amid fears of a looming Lehman Brothers moment that could spark a major chaos, especially if their bonds are blowing up and their UK position is blown up, or their currencies that they've been trading are blowing up, right? This is where the fun starts, right? Because there's too much pressure in the system. There is too much fraud, manipulation, which has caused everyone to have great amounts of wealth. You think that you're wealthy, right? We all think we're rich. We're only rich because it's not because the property got any better. It is because your money bought less, because there's just been so much of it printed via different sorts of financial products out there. This article goes on to say Credit Suisse is scrambling to reassure investors and clients about its liquidity and capital position as rumours swirl that a major global investment bank is on the verge of collapse. The troubled Swiss lender, which has seen its share price plunge by 60% over the last year to a record low, right? They say buy bank stocks, right? If your super fund had you in bank stocks, and you would have been screwed, right? You would have taken a bath. It says here that the share price of Credit Suisse has dropped by 60% in the last 12 months. Following a string of scandals and losses, saw a sharp rise in spreads on its credit default swaps on Friday, sparking a fevered online speculation. Credit default swaps offer protection against a company defaulting on its bonds. If the bonds are going up and people can't afford those bonds, what will occur? They will go insolvent. And if they go insolvent, who's the one that's holding the bag? They're the ones that's going to end up losing their investment. So, credit default swaps offer protection against the company defaulting on its bond. A rapid rise in last week of around 15% to levels seen in 2009 during the financial crisis suggested investors were worried about Credit Suisse financial health. Then there's all these posts on Twitter that they're going broke and all this sort of stuff. The Financial Times reporter, senior Credit Suisse's executives spent the weekend hitting the phones trying to calm the nerves. The teams are actively engaging with our top clients and counterparties this weekend. An executive told the newspaper, "We're also getting incoming calls from our top investors with messages of support." That came after the group's chief executive, Ulrich Körner, issued a memo to staff on Friday saying that the bank was at a critical moment as it prepares for its latest overhaul. The details of the major restructuring, which is expected to include up to 5,000 job cuts and asset sales, are expected to be revealed in a strategic review in October 27th. So let's just think about that, right? Let's just remember that date, October 27th, and just revisit what that has to say. The details of the major restructuring, which is expected to include up to 5,000 job cuts, right? We're hearing all about jobs, unemployment levels at record lows and all this sort of stuff. But now we're seeing job cuts because we're in a recession, right? And asset sales. So an asset sale is, what is the asset to the bank? The asset is you. The asset is you as your mortgage, is your mortgage contract. It is whatever other sort of asset they've got, whether it's a shopping centre, whether it is a marina berth, whether it is shares in building an airport. All those things are asset sales. So if they have to pull liquidity, if they sell those things off, well, then that means that there's more of these things going in the market and less liquidity out there, that means that we are heading into a massive financial storm. So yeah, it's quite interesting because it's exactly on point with the timeline. If you all remember, when I said September to October this year, we would see the crash, right? And it's how they behave through this crash which will determine what will happen next. And the only way that they've got is either to let it implode, which will blow up everything in the system. And what I mean by that is, let's say, for instance, this institution has investments in all infrastructure projects and stuff like that. The government can't keep building its bridges, the government can't keep building its airports, the government can't keep building its roads, because these are the guys that make financial products out of that. If there's no liquidity around that, right, the roads are going to stop. The things are going to change, and that's a big issue for the world. So the only way for them to get over this is to re-stimulate and put more liquidity in the system, and this is when we'll start seeing things go negative there. So no doubt there will be noise in the markets and the press between now and the end of October, he wrote. All I can tell you is to remain disciplined and stay as close as ever to your clients and colleagues. When you hear about it, like stay safe and as close to your clients and investors and colleagues, well, that sounds more like the Titanic is sinking. It's like group together and preserve your heat with each other, right? Hold on to Rose's hand and watch her drown or whatever happened to the Titanic. That is a very interesting comment to come from the head of the company. It is not easy to remain focused amid the many stories you'll read in the media, in particular, given the many factually inaccurate statements being made. That said, I trust that you are not confusing your day-to-day activity stock price performance with a strong capital base and liquidity position of the bank. Speaking to the Financial Times, a Credit Suisse executive also denied recent reports that the bank had approached investors about raising more capital. The executive insisted that the bank was trying to avoid such a move with its share price near record lows and higher borrowing costs due to ratings downgrades, right? So the costs of borrowings have gone up. If you think that you don't have any effect with these banks, if you have a loan with a second tier lender, whether it be a La Trobe, a Liberty, a Pepper, any of those second tier sort of lenders, where do you think they get their money from? Where do you think they get their money from? They get your loan and they literally package it up and then they go and sell it to these sort of companies. So these companies are who you're paying your mortgage to every week, right? These are the company you're paying your mortgages to. So if they go under, it doesn't mean your mortgage lapse. Like you're the asset, right? Your asset gets sold on to another lender and another back-end provider, which will be able to repackage you up and sell you again, right? Anyway. I can read all that, but you get the picture. Credit Suisse, the biggest bank, one of the biggest banks in the world, is in a big issue at the moment, whatever that is, wherever it comes out, right? That is not an instillment of confidence. If we go back and hop into the time machine, get back in the DeLorean and go back to 2019, it was actually September 2019, pre-illness, that was out there. Wow, my throat is burning, like I probably have it, who knows. I'm pretty hot too. But anyway, it's we get sick sometimes. But what happened is one of the banks, whether it be Deutsche or one of them, had gone under back then. And they had to re-liquidify the bank. And what they were doing is buying up the short-term bonds back in September 2019. And it ended up going from like 5 billion a day, 10 billion a day for only 2 weeks, and it went on to 8 weeks and 10 weeks and 14 weeks. It's called the repo markets, the repurchasing agreements. And I made videos of this stuff back in the day. I sounded like a fuckwit back then. People were like, Birchie, stick to property. That's what you're best at. Don't talk about this stuff. You've lost me. Unsubscribe, whatever. And then, we started seeing funny business happen. And then everyone's like, wow, what's going to happen next, right? I'm telling you this shit before it happens. So I'm doing the research. I'm looking at it. I'm so excited by it. So, yeah. Here's the next article. Now, these articles are from the AFR. And I feel like there's been a bit of comical value in the AFR with some of their articles, especially my next one. My next article is crazy. Look, it's even got a little chicken on it, right? We're going to get into that shortly. Alarm bells are ringing with global markets in growing disarray. This was from October the 2nd. Investors are bracing for further financial market ructions this week as rising interest rates and slowing economic activity collide with global debt levels that are at record highs. So we have record high debt globally, and we've now seen every single country increase the cost of that funding of that debt by 2,000% in 6 months. You think that that's going to fucking work? It's not going to work. It's going to cause the biggest recession that you've ever seen in your life. The only way for them to get out of this is just to keep printing over it. But if they print over it, they're going to have to print a lot more money than they printed last time, which will cause even further greater levels of inflation, which will either devalue your cash that you're holding, your savings that you're holding, but will also increase the value of all of your assets that you hold, whether it be the glass that you have, whether it be the sparkling water that goes in there, the cost of that going up. Inflation is going to hit everyone. If you think you're out of the woods with inflation, we haven't even seen inflation take off yet, right? Just wait for another 12 months, 18 months, 24 months. That's when the real party's going to get started. And very, 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 very exciting. As we've witnessed so too often in the past, the odds of major financial blow-up, such as the global financial crisis and the collapse of dot-com bubble and the collapse of the US hedge fund long-term capital management, are magnified in the period immediately following the US Federal Reserve tightening cycle, because they tighten it and then they realize they can't tighten it, right? They have to do something. They have to show that they're doing something, but they can't do anything because they're screwed. The combination of increasing rates and stronger US dollar are hurting economies around the world. Well, that's right? Because the more that the US increases its interest rates to try and starve off inflation themselves, the higher that they increase their interest rate over there, it means that their dollar becomes more valuable. So you need to pay more money to go and buy the US dollar, which means that anything that's being traded in the US dollar adds further inflation. If you want to stop the inflation, you need to drop the US dollar. And that ain't going to happen in time soon, right? Because they keep increasing it, which will cause further pain, because the more inflation they're creating, they're just adding fuel to the inflation that's seen in all the other currencies. The reason being is the US dollar is the base currency of the world, and that's what everything's traded into. Investors have been deeply rattled after last week's turmoil in the UK bond market, which supposedly stayed pension and insurance funds played a central role, right? Pension and insurance funds, right? So if you're invested into these financial instruments that your financial advisor sells you, then you're getting prepared to be wrecked, right? It's pretty funny, right? Like when you think about a financial advisor and you think about they have to go to university and they're told that they can only sell within this spectrum of products. So they can sell this, and if they go outside of that, then they lose their licensing and they could end up in jail. It's the same as when you see a doctor go. They might understand nutrition, but they're not allowed to talk about nutrition. They're only allowed to talk about the products that they can sell inside of that product. You go and look at what a lawyer can talk about, right? They can't talk about common law in certain ways. They can only talk about things that are inside that box that they're allowed to sell. So when you start looking at, how everything is sold and how everything's packaged up, and you realize that the whole system is really a scam. And that's where the fun starts. Investors are only now becoming aware of how many financial institutions, including stodgy pension and insurance funds, adopted dubious financial strategies to boost their investment returns. Wow, you saw 6% return on your super fund and your managed portfolio of shares? Great, that's an amazing return. That's shit return, and the amount of risk that's surrounded by it. I have zero paper assets, zero. None, right? Doesn't mean that I don't see that there could be value in them in the future, but I just don't see any value in them because they're so Ponzi schemed, right? They're such a big Ponzi scheme. But that's what they're investing into. The problem is that financial strategies are almost invariably predicted on the continuation of ultra low rates, right? Surprise, surprise. Right? Everyone's addicted to these rates because they can't go up. If they go up, everybody dies. As a result, they failed to predict the disastrous losses that would arise if interest rates were to rise abruptly. Oh, whatever this chick's name is, what's her name? I saw it here beforehand. Oh, here we go. I'll find it. This lady here, Karen from the AFR. She said it, right? She said it here. When did she say it again? As a result, they failed to predict the disastrous losses that would arise if interest rates were to rise abruptly. That is why I've been sitting here week after week. Every Tuesday, I came back to do the Tuesday Night Lives because I saw this happening. It's writing on the wall. I'm not always going to sit here and do these videos, right? But I'm here to walk you through the biggest wealth transfer of our lifetimes. And it's exciting, right? It's exciting. I've got a goal to be a billionaire in the next 3 years, right? And I'm going to get there, right? And I'm going to get there because I have to understand how all of this stuff works. Yeah. That is exactly what has happened as global inflation has soared, prompting global central banks, including the Fed, to shift towards the tightest monetary policy stance in 3 decades. It's interesting, three, but surprise, surprise. The Fed's aggressive rate rises have helped fuel the surge in the US dollar, dealing yet another shock to the global financial system, with the Chinese yuan hitting the lowest level against the greenback since 2008, while the Bank of Japan intervened to prop up the yen for the first time since 1998. Cracks appearing in the bond market. Investors first fret that the US dollar strength also reflects a high level of distress in financial markets, which has prompted investors to seek refuge in the greenback. The problem is that the Fed's monetary tightening also involves US central bank whittling down its massive $9 trillion or Aussie $14 trillion portfolio of US government bonds and mortgage-backed securities by $95 billion a month, a process known as quantitative tightening, right? So all these terms, right, there's no point watching any fucking media believing anybody if you don't understand what's coming out of their mouth, right? If you don't understand what quantitative tightening is, if you don't understand what a mortgage-backed security is, if you don't understand how bonds work, if you don't understand how many digits are on $14 trillion of fucking bonds in America, in the US, then you're not going to survive. You're not going to get ahead. You're not going to know how it works, right? So if you want to play, like whether it be property, whether it be shares, whether it be business, whether it be whatever, you need to understand how the game plays to understand how the pieces work. People just want to look at the pieces and think they're an expert holding a plastic house on a Monopoly board. Your plastic house on a Monopoly board is nothing. It's absolutely nothing. It's the system that's where it's all at. It's where the game is played from, which is important to have that knowledge. Because if you have that knowledge, then you can take advantage of everything that's on top of it. But where are we here? That's causing cracks to appear in the $25 trillion US bond market, which serves as the bedrock to the global financial system. Well, you've never really heard of these words beforehand, the bedrock of the financial system. 25 US trillion dollars of bonds, right? We were just talking 2 seconds ago about the $14.1 trillion worth of bonds in mortgage-backed securities. There's $14 trillion of mortgages that the US dollar has got mortgaged, right? They're the bonds. And there's $25 trillion US, that is, it's probably like 32, $33 trillion worth in the US bond market, which is just for, paying the posties to deliver the mail and paying for all the commies to sit around the politicians at the politician table and Biden to get his fucking colon checked because he needs to, and, his dementia tablets and whatever. The traders complain that liquidity, which refers to the ease of buying and selling an asset, is drying up in what is supposed to be the world's deepest market. As a result, trading in many bonds has become more difficult. If the US bond market were to seize up, if the US bond market was to seize up, have you ever heard that beforehand in the news? It's like a conditioning. It's a conversation starter, right? You've never heard about inflation before 2 years ago. You never heard about hyperinflation, apart from if you were watching me talk about this stuff 5 years ago before I said it was going to come, because these things have to happen to take place. So the world that you're going to be left with at the end is going to happen. We need to have these things happen. But if you can foresee them happening, if you can understand how it happens, if you can then take advantage of it, that's where the fun is. But it's saying that if the bond market was to seize up, the US Fed would have little choice but to follow the Bank of England's example and launch a fresh bond buying program. That's what we're going to see, right? Everyone's asking me when's the rates going to get cut? When's this going to happen? What's going to happen, right? Just stop looking at the interest rates. Who gives a fuck about it? The money never existed. The debt never existed. The house exists. These fucking bricks exist. This glass exists. All the things that surround us exist. This debt never existed. Your wealth doesn't exist. It's your belief system in it. Someone said their Tuesday night church with Birchie is a belief system that money exists, right? And if you have enough belief in that, then it believes, right? I don't have a care. I know it doesn't. I know that the monetary system is all made up, right? Not about the church stuff. That's a very different topic, and there's lots of. That's a totally different topic. Maybe we'll have a good chat about it. Things that you shouldn't talk about the dinner table with Birchie chat one night. But yeah, looking at it, they're saying now that if they get screwed, that they're going to have to be stuck to buying their bonds back again. They've already got fucking $30 trillion of bonds. They have $30 trillion of bonds already. That's the biggest Ponzi scheme that's ever existed, right? And they're saying, well, oh, if we get stuck, we're going to have to print a lot more. How much more are they going to print? We're going to have $100 trillion fucking dollars of bonds shortly. $100 trillion of bonds. So just mark my word, right? When we get through this next cycle, right, whether it be 1, 2, 3 years, probably wouldn't be after 3 years, it'll probably start the next year. We're going to see bond buying programs, just like what we're reading here. And we're going to get to $100 trillion US bond debt, right? It's going to double, right? It's at $30 trillion now. It's going to double to 60. It's going to double to 100, right? 120 would be double, but it's going to just jump up, jump up, jump up. Right, I ain't going to go, oh, it's $30 trillion, let's make it $32 trillion and call it square, right? This shit's going to go all the way up. It's going to fucking double and double and double. And that's what's going to cause the hyperinflation. That is where the hyperinflation comes, because they're just printing this money up. It's all made up. It is all made up shit. And they're saying that they can't do anything apart from buying it. So the Fed, here's a question I have for you, right? Is if the Fed has to buy up the bonds, right? If the Fed has to buy up the bonds, they're not going to be able to afford to buy up the bonds paying 2.50, right? 2.60. They're only able to afford buying the bonds at 0.1, right? How would they reduce their balance sheet? If they were negative. If they were negative. We should have been negative already. They will go negative after this. Whenever it happens, the longer it goes on, the bigger they go up with the rates, you should be cheering, right? Most people are like, oh, could have spent an extra $20 a week, right? Fuck the $20 a week. The reality of it is that the more pain there is, withstand the pain. It's like going to the gym, do heaps of weights and get big, right? The more pain you go through, the more that muscle grows. The more that the market has to go through that pain, the more that we're going to see out the other side, right? The bigger these stimulus package is going to be. And these stimulus packages aren't going to be like the stimulus packages before. They're going to cause us to go to hyperinflation. 100%. Anyway, let's get back to the article. Most analysts agree the Fed will only change direction and start injecting liquidity into the financial system if a significant financial institution or country finds itself at risk of a bankruptcy. Well, we've just read about the Bank of England. We've just read about the UK. We're now seeing every fucking country around the world is in a recession, right? Every country, every large corporation's losing money. Every business is losing money out there. There's lots of business making money, but all the fake Ponzi scheme businesses that were made up on this cheap credit, they're all falling apart, right? They're all falling apart. So what's the chance of seeing a country go bankrupt, a bank go bankrupt? We're seeing that they're buying up the bonds at $5 billion a day. Let's just look back, right, and remember that I said this today, right? In the next month, right, they said they're going to put for 13 days, they're going to buy $5 billion a day, right? I bet you that will go longer than 13 days, and I bet you that will increase from 5 billion to 8 billion to 10 billion to 15 billion and continue to go up. And we will see that. And that's something we can go back and have a look in a month, right? And if they do that, that means that they're completely and utterly fucked because the repurchasing agreements have collapsed. The bond market has collapsed. So the only reason why they're going to be buying up their bonds is if we see a country go bankrupt, a corporation go bankrupt, or the bond market implode around the world, right? If your money's invested into that and you go, I don't have any bonds, fuck that. If you have a super fund, you are invested into the bond market. You are invested into the bond market. Anyway, at the same time, concerns are mounting about the intense drains now evident in the US corporate bond market. Oh, funny that. Um, in their latest note, this is how it breaks. The Bank of America bond strategists warned that with credit stress approaching critical levels, now is the time to put emphasis on risk management. You should have been doing risk management from fucking day one. You should have been doing risk management from day one. They argue that the Fed should slow its clip of interest rates and potentially hit the pause button to allow the economy to fully adjust to the extreme tightening already implemented, but still working its way through the financial system's plumbing. They fucking nuked it, right? They nuked the financial system's plumbing, right? By putting the interest rates up more than 50 basis points. By more than 50 basis points, blew up the whole system. A failure to do so, they warn, raises the risk of credit market dysfunction, which, if it occurred, would be difficult to contain and fix. Meanwhile, even erstwhile bulls such as J.P. Morgan's global market strategist Marko Klankovic are anxious that central banks are on the verge of committing a major policy blunder. We've got J.P. Morgan talking about the risk around it. In his latest note, Klankovic, Kolonovic, argues that central banks and they made their mistake of continuing to ease monetary policy into what he dubs the crypto NFT innovation bubble in 2021. But now central bankers are pushing ahead with unprecedented tightening as the US economy slows and the war in Ukraine rages on. Come on. The war in Ukraine is the reason because of this. Wait for the fucking thing they're going to blame it on, right? The reason why I said that the whole thing was a scam is because they mopped the floor, right? They mopped the floor with the alleged sickness, right? So now they're saying that it's the US economy slows and the war in Ukraine. Fuck the war in Ukraine, right? It's got nothing to do with that. It's because they robbed everybody. Everybody's been robbed. And it takes me to my funnest article. This could be one of the funnest articles I've ever read to you guys. So let's sit down, have a story time, bedtime stories with Birchie, and read through this article. I had to print this off because I couldn't. I've got it off from the paywall at 12ftio.io, which is a way to remove the paywalls. And I just copied the text and printed it. So it doesn't say AFR, but it's from the AFR. Central banks trapped in their own Ponzi scheme. Right? If you read this article, you'd probably think, fuck, has Birchie taken up a job at the AFR and written a funny piece, right? Because it's literally all this should have been saying. It's all this should have been saying before it happened. Before it happened. Let's have a little sip of bubbly water and get into it. Central banks trapped in their own Ponzi scheme. Macquarie's Victor Schvetz says global markets are addicted to low rates and high liquidity, giving governors no choice but to pivot despite high inflation. Oh. Here we go. Let's just read it again because it sounds fun. Global markets are addicted to low rates. Exactly. That's why we're stuck at zero interest rate policy, and we're going to see the rates come back down. And high liquidity, giving governors, or the people that policymakers, should we call them, no choice but to pivot, right? Because they can't push the rates up, even though inflation is great. And if they don't increase the rates, it's going to cause hyperinflation. It's either how do you want to die? Do you want to be shot or do you want to be stabbed, right? Either way, you're going to get shot in the head, stabbed in the head. Who cares, right? That's what's going to happen to the economy. We either see it from deflation or we see it from hyperinflation. They're not going to allow it to deflate. It's going to happen through a hyperinflation or currency crash. It's happened throughout thousands of years, right? If you have cash, you lose all your value. If you have an asset, it goes up in value. But you're not rich because everything else has gone up in value around you. So you just want to take as much shit as you can, as much debt as you can, pay off the debt before the money completely dies and the money is worthless. So I hope to pay out a mortgage with a Big Mac. People might say it sounds, stupid, right? But when the value of a Big Mac's worth $100,000, like it is in some third world country, well, then that's when you start to, see that you can do so. Here we go. This is really funny, right? Because there is no name, right? There's no name here. It has like Macquarie's Victor Schvetz says. So it might be from that, but normally it has like under the under the date, it says here the person's name that's writing the story, right? But it doesn't. The person probably fucking allegedly topped himself tonight after putting this article out because it's so funny, right? It's so funny. For the first time in a long time, could the Reserve Bank's Philip Lowe be ahead of the curve? Ahead of the curve, you wouldn't have done this in the first place. Ahead of the curve would have let the thing crash fucking 2 cycles ago, back in 2008, right? Um, in his most recent public appearances, Lowy has stressed that at some point it will be appropriate to slow the rate of increase in interest rates. We're going to slow the rate, right? The only people that are slow are the ones that are believing this shit. Until a week ago, that seemed like a throwaway line, a way for Lowe to give business, households, and investors a little light at the end of the tunnel. But suddenly, right, suddenly in the month of September to October, right, the month of September to October, which is, when we talked about it going back 6 months ago, um, uh, suddenly global bond markets spluttering with rumours of calamity spreading like wildfire, and with Lowe's counterparts in Britain, Japan, China intervening with markets. So people are asking which markets are fucked. They're saying that in the UK, in Japan, and in China, they've intervened because the markets are fucked. Right? Now, how long is it going to take for them to admit that our markets are fucked and for them to intervene? Right? I will guarantee you that in this next phase that we go through, it won't just be interest rates dropping. It will be free money. Everyone's going to be like, did you see there's articles where people say, you go and put this into your arm and we'll give you free chips and hamburgers? And they go, oh, chips and hamburgers will taste so great, right? All this sort of shit. Chips and hamburgers, they tried to make it sound so fun, right? And it's talking down to people like stupid. They will try and sell their central bank digital currency. They will say, you be a good boy, you be a good girl, you do this, you get that. You do this, you do that, you get that. And they will give stimulus packages via central bank digital currency, which will be backed, it will be based on like an ESG, an environmental social governance score. And they will introduce that through this period of time. So, um, yeah, this goes on to read, even in the US, in the United States, where the US dollar and bond markets are still gyrating wildly from the 1-2 punch delivered by the Federal Reserve Jerome Powell, first hawkish speech at the Jackson Hole in August, then the Fed's 0.75% rate rise in September, there are signs of a shift in attitude. Of course, there's going to be a shift in attitude because the whole market's going to implode. Last week, the Fed Vice Chairman Lael Brainard and Fed of San Francisco President Mary Daly separately reaffirmed that their commitment to fighting inflation with higher rates, but expressed some caution about how fast the increases need to be. This is starting to sound like a sign of defeat here, right? Lowy will probably raise Australia's official interest rates by 0.5 percentage point on Tuesday. Well, he didn't. He put it up by 0.25 because he's fucked, right? Adding to the sharpest ever tightening cycle. Yes, that would be correct. It's gone up from 10 basis points to 260 basis points, meaning that it's gone up 2,500, 2,600% in 6 months. It's pretty funny, actually. Really funny. You think you're doing tough because the interest rate's gone up 1 or 2%? Who cares about that? The businesses, whoever took out the debt at 10 basis points and is now paying 260 basis points, that's gone up 260 times, 2,600%. 26 times, sorry. It's gone up more than Bitcoin. It's gone up more than any cryptocurrency. If everyone's like, oh, I'm so great, I got some crypto, right? Those bonds, that's what's gone up, right? Imagine printing these things, it'd be amazing. But what will reiterate his warning of the rock and the hard place that central banks and particularly the Fed now find themselves caught between. On one hand, there is runaway inflation, which continues to rise at core level, excluding energy and food, and is potentially embedding worrying changes in the longer term inflation expectations. There must be fought with higher interest rates. Right? One hand, there is one runaway inflation, which is exactly what I've been saying here for the last 6 months to you guys. This is what I said at the start, going back 2 years ago. It's what I said 5 years ago, which is exactly what is happening now. It's like I've been to the future and come back. I haven't. I've just read charts and been a dork and understood how the system works. I'm like, fuck, like this thing is much sort of, they're screwed, right? On the other hand, is mounting evidence that the speed in which rates have risen, well, it's not the speed in which rates have risen, it is the amount that the rates have risen, is damaging the plumbing of the financial system. Bonds, currencies, and liquidity. Because this is fun. Bank of America credit strategist Oleg Melantev and Eric Yu have argued that measures of credit stress have jumped to a borderline critical zone. A borderline critical zone. You couldn't even get the fucking rates up 2%, you fucking piece of shit, at the central banks, right? You couldn't get them up that high, right? You couldn't even get them up 2.5%. That's how screwed the system is. That is how screwed it is, right? The Fed must slow down and allow the economy to fully adjust to all the extreme tightening already implemented. No, because in the start of next year, right, in and around March, April, May, right, that's 3 years since the sickness started. It is 4 years in June next year since the cycle went to a tightening, it went to a relaxing cycle. An easing cycle. So monetary policy 4 years ago in June next year. So all those bonds are going to start blowing up, right? Some that booked their bonds in at 0.5%, they're now paying 2.5%. They've gone up fucking 4 times, 5 times. It's crazy. Anyway, you think there's going to just stop here, right? Everyone said that interest rates wouldn't be going up till 2024. That's actually probably true. This Lowy bloke was probably right when he said interest rates won't be going up until then, right? Because really, they've just gone up and they're going to come back down right now. But in the future, once the currency crashes, they're going to have to be forced to push them up to 10, 20, 30, 40%. Interest rates will go up through the roof, right? If you think you're worried about them now, they will go negative. But then in the future, at some point, when the currency loses all of its value, the rates will most likely go up 10, 20, 30, 40%. But when a Big Mac meal is 150 grand, 200 grand, your wage is $2 billion a week, your mortgage is, whatever, that's when, you'll start going, fuck, what really just happened here, right? For many investors, the mere suggestion that central banks could soon pivot back to buying bonds and printing money to fix a problem caused by 15 years of buying bonds and printing money is offensive, right? I told you, I said it straight up, that they are fucked. They're completely screwed. They justifiably see 2022 as the dose of reality that markets and economies need after too long spent in fiscal and monetary la-la land. What, at a 2% interest rate? I can't afford a 2% interest rate. Fucking hell, this system is so bad, right? Anyway, we're starting to see it. As I said, this article is from the AFR. It's not something I made up. This is from the AFR. This is exactly the things that we said way, way before. The Bank of America strategy guru Michael Hartnett says the inflation shock that caused rates shock, which now threatens recession shock and credit event, reflects painful regime change as bullish deflationary era of peace, globalization, fiscal discipline, quantitative easing, zero rates, low taxes, and inequality gives way to an inflation era of war, nationalism, fiscal panic, quantitative tightening, high rates, high taxes, and inclusion. There is clearly something very attractive intellectually and, dare we say, morally about the idea that we are seeing now global markets is a bill for 15 years of financial repression and excess coming due, and this is simply the return to a more normal world where capital has cost and risk has been priced. Well, it can't happen, right? And we're now starting to see the ramifications of it. And we've got talks from people around the world. This isn't the conspiracy theory channel anymore. This is mainstream media talking about this, right? It sounded conspiracy theory 2 years ago. It's mainstream on the AFR right now. And this is an article from the day. The pain is not pleasant, but is necessary. But highly respected Macquarie strategist Victor Schwetz has a very different view. He argues that such a normalisation, neither probable nor perhaps even beast of liquidity, with a determined but futile attempt to raise the cost of capital, would be too risk of the sort of carnage that usually involved massive economic and social dislocation, and were preceded and or followed by revolutions and wars. You're going to mop the floor and say, oh, it's Russia's fault, Kim Jong Un's fault, China's fault, the sickness, Birchie being sick, fault, whatever the case may be. They will find something and they will blame it. They will not sit there and say, okay, we robbed everybody of their savings, we robbed everybody of their time and effort to go and earn money, and that system was a complete and utter scam. This guy, whoever it is that wrote this I threw it. Here we go. Whoever it is, the faceless person that wrote this article, I'm just amazed that it made its way to the AFR. Make no mistake, Schwetz is not arguing that the regime of low interest rates and abundantly liquidity is a good thing. It has become clear over the last decade that if we persist with predominant reliance on excessively loose monetary policies, the outcomes will get much worse, and eventually societies could potentially collapse, he says. We don't feel like our society is collapsing nowadays, guys. We have been advocating for a gradual switch from monetary into a mix of monetary and fiscal, as well as redistributive policies, but there is a grave danger in this transition. As we have been highlighting, the change needs to be carefully calibrated and spaced out. Why? Because what Schwetz is variously describes as a pyramid or Ponzi scheme that central banks have helped create through their policy choices, everybody has participated. Whether you've bought a house for a potential growth, whether you've bought a vehicle for potential growth, if you haven't sold your time for a day's labour and not invested, you have played a part in this Ponzi scheme, right? It's knowing how well this Ponzi scheme is, and it's being able to play at the table with it. It's great. Over the past 3 decades, monetary supply has grown at between 2 and 3 times the rate of GDP. This has helped promote the financialization of all corners of financial markets, contributing to a whopping increase in global debt levels, which stand between 3.5 GDP and 10 times GDP, depending on whether you want to include the value of financial assets, the value of derivatives, and the value of underfunded liabilities, such as pensions. This leverage creates vulnerabilities across economies. Global government debt is estimated at US $90 trillion, Australian $140 trillion. $140 trillion. Just think about that for a little bit, yeah? It's a lot of money. Emerging markets, particularly China, have seen debt levels explode. Any change in the cost of capital will have major ramifications. No shit. No shit, guys. No shit. It's a similar story in the US $10 trillion private equity sector and the new US $3 trillion digital assets market, both of which we've seen aggressive use of leverage. In the corporate sector, Schwetz says the number of so-called zombie companies, non-financial corporates, which failed to cover interest costs for at least 3 years as a percentage of total listed market, is estimated to have increased from about 10% 20 years ago to 20% in the US, and from about 5% to 10% in Asia. The household sector destruction of wealth is higher rates pushed down house prices and equity prices. Well underway in Australia would be the biggest worry. Schwetz's summary is simple. It is very hard to unwind the Ponzi schemes. There is no getting away from the tight rules of our monetary economy. Ample liquidity and low rates. Hence, there can be no normalization. We can't normalize this, guys. We can't normalize this. Over the next 3 to 6 months, central banks will be testing the limits and hence volatilities are likely to rise further. However, at the end of the day, policymakers will pull back from the precipice and continue to expect a change in tone of communication strategy by the end of 2022 or early 2023, and followed by a reduction of rates by the end of any pretense quantitative tightening through 2023 and early into 2024. Schwetz says the financial conditions are tightening and spreads are widening, and there are no signs of stress experienced either the GFC or the peak pandemic early 2020. Here he appears to agree with Harder. He says central banks aren't yet ready to panic, the sort of coordinated way that they deliver a rally in global equity markets. I'm going to leave it at that, guys. You asked me when interest rates are going to drop. We're here. We have seen a flattening of this curve. I expect to see this to come forward. Somewhere between March to June 2023 is when we're going to see rates drop. Boom. There's my prediction. No financial advice. Any of these financial commentator regulators here watching, good luck, have a good life, and come talk to me somewhere outside in the dark and we'll have a conversation about it. Reality is that the writing is on the wall. The writing is on the wall. They are now starting to write it into the media. Amazing time to be alive. Amazing opportunities. All the scaredy cats out there, go back and don't make decisions, right? A lot of people will sit there and be like, oh, I wish I made a decision 20 years ago. I wish I got into property. Now's your chance. It's not property. It's anything out there, right? Anything that's on sale, anything of value. Some people are right, have some cash. And that cash, you want to be buying shit as it's cheap, because you're never going to see it as cheap as it is now, because as soon as they change monetary policy, as soon as they change direction of monetary policy, we're going to see everything inflate like never beforehand. Going to read through your questions, then I'm going to head off. I feel sick as a dog. Throat is on fire. Glands are on fire. Feel like I've got a clogged nose, and I really feel tired. So I thought I'd pop online as my commitment, as I am here every Tuesday night. Some important news to discuss, so that's why I thought I'd hop online. Dan says, what do you think the cash rate will top out at? As I said last month, I said there's 2 potential rate hikes. It could be 25 basis points. I don't know how far they're going to push it. The more they push it, the funner it's going to be, because the more stimulus package they're going to have to do on the other side of it to clean up the mess of what they're causing. So I predict we might have one more quarter percent, 25 basis point increase, and that would be it. Con says the result of kicking the can down the road without addressing the real issues. We're in for some real tough and bad times ahead. I think so. Andrea posted the video to what you need to know about hyperinflation. That's the video I talked about, or I remember at that point talking about when it would happen. Jason said here, get your self-managed super ASAP. Whilst we can't give financial advice because I'm not the financial advisor guru out there like all these experts that own no assets in these large positions that can give you that advice. I do not trust those super funds. I think there's a lot of debt and a lot of risk. You've seen that in the articles that I'm reading out to you guys now. It's becoming mainstream. I won't give advice about doing a self-manage or not. If you are thinking about, if you have $100,000 or more, that 100 grand could be 50 with you and 50 with your spouse or whatever. If you have 100 grand combined, it might make sense to reach out to my team, admin at B.Invested.com.au, put in the heading super fund, and then put in what you're trying to do. I can put you in contact with someone that can discuss, how to get into that self-managed super fund space. I've had a super fund, self-managed super fund for 10 years, 12 years, 13 years. I remember back in the GFC, I put 5 grand in my super. I looked at the next quarter statement and I had 10 grand less than what I started with before I put the 5 grand in. I was like, someone's ripping me here. I pulled the money and bought property inside it. Peter had a nice comment here saying that, and laughy faces, he's having a little bit of a laugh, saying that I don't have a clue about what's happening out there. Well, keep watching TV, keep boosting yourself up, and following what the system has to say, and I wish you the best. Matt said here, funny how the Catholic Church got all their gold, etc. back almost a day before shit hit the fan. You make a very, very good point there, Matt. A lot of people don't realize or remember. I read an article going back a month ago, which was from the Vatican. They said that they gave to the 30th of September for everyone to bring their money back into the Vatican Church, Vatican Bank. Otherwise, you know, you're going to hell or whatever, right? They specifically highlighted the 30th of September. What did they know by the 30th of September? It's actually, I think, by the 24th of September or something. They gave 30 days notice for everyone to get their money back. There's specific dates with specific things that are out there. There's a lot of calculations that you and I don't get to sit at a table and get to be a part of those meetings with controlling powers. But there is signs that are left out there, and it's finding and highlighting those signs, seeing how those things stack up, seeing where the opportunity is, seeing where the risk is. But you make a very, very good point there, Matt, that the Catholic Church did say, the Vatican City actually, not the church, the Vatican City, the Vatican Bank had actually said that they want to get all their money back in by the 30th of September, I believe it was. So, yeah. Ryan goes, hey Birchie, can you have a self-managed super fund at any age, and will it affect further borrowing for investments with the banks? It's a very good question there. If you have a self-managed super fund, you can borrow inside of that with lenders. It is a non-recourse loan. There is a very large amount of hoops to overcome to get finance in a self-managed super fund. It is not reliant upon your income. They do not take in consideration what other debts you have. So a lot of people feel like they're stuck. They can't buy anything under their personal name, but they might have $250,000 in their super fund. They might go and buy 3 properties in their super, and they might be able to go and borrow for those properties because they have the ability to, because they're non-recourse loans. They're based on the contributions that you put into the super fund. So, yeah. Sacco said, I don't see you doing live Facebook every week, guys. Taking the time to do this. Don't appreciate it. Thanks for the support there, mate. Appreciate that. Dan wrote to the hater saying that I was wrong. He was spot on with calling the hyperinflation. He's been 90% spot on with picking the economy better than any government and anyone at the RBA. Thanks a lot for the support. I'm going to smash a like for your comment there, Dan. Appreciate that. I appreciate everyone tuning in every week, and that's sort of why. I mean, how sick I feel, doesn't matter. I don't have a printer. I literally got a printer here. Like, it's still got all the tape on it. I literally went down. I'm going to pick up my printer and share with you. Still got all the tape on it. Literally just went and picked it up to print off those articles to bring you tonight's live, just because I did. So thanks for watching. Matt says here, Bunnings is now accepting Afterpay. Get your snag on the bread with credit card, pretty much. He said, yeah, I work there and we already have OpenPay and ZipPay now. This demographic that you, wow, I actually thought you were taking the piss, Matt, just as a laugh. But yeah, wow, crazy. Matt said, I wish I had the DeLorean. They've actually made a new DeLorean that just came out the other day. You can get your spot. I'd love a DeLorean. I went to buy one a few years ago, but no one has one for sale. If someone can get me a DeLorean, I'd actually buy it right now just for the fun of it. So Pete said, forgot about the daylight savings. Yes, guys. New South Wales, Queensland, Perth, everywhere different. We've got daylight savings as of this weekend, an hour behind. So if you're in Queensland and it's 7 o'clock, now it's 6 o'clock in Queensland when we come on live. So Matt said, which country do you see crashing next? Japan, Euro? They're all going to implode one after another. I don't know who is going to pop next. I don't have that data. I'm not that intelligent with access to that information, or privy to that information, should I say. But they will all, these news is coming out. You've seen all the interest rates go up. You've seen every country saying we've got this boom, that boom, the next boom. Everyone's got the same news, right? So you can just take off Bank of England and put the RBA on it. You put the Bank of New Zealand on it. You can put whatever bank you want on it. This will happen globally, and it's going to happen over the next 3 to 6 months. It started now. Just remember, it's happened September to October 2022. And if it doesn't implode in the next 3 weeks, 4 weeks, 5 weeks, 6 weeks, it will occur, March, April, May, June next year. The system cannot support the amount of debt, the lack of liquidity, and the cost of that debt. It can't be supported for too much longer. Kane said here, do you think the central banks are trapped in their own Ponzi scheme? Yes, you've been on Birch Feed. You have seen the article there, Kane. If you guys are watching this, it's free, right? Maybe that other hater beforehand laughing and shit, saying I didn't get it right, um, which I did. Um, should go and join up to Birchfeed. It's free. It doesn't cost anything, right? Birchfeed.com. That's it. Just go and join up. I send articles every day. Give a little comment. I'll post shit. I just might see an article like, "Hey guys, this is pretty sus. This is what it is." Sometimes it's weird shit. Um, I've talked about the weather beforehand. Nowadays, when you look at the weather, there's a lot of lines in the sky. I've talked about some odd stuff that's out there, but I'd say 80% of it would be attracted straight back to property or financial space. Now, the other 20% would be just uncovering the lie of what we live in. So I post there daily, so go and, yeah. Kane, I remember in 2016 you predicted hyperinflation would happen, but only after a few cycles of QE. It's looking like you're on the money. Thanks, Kane. I did. I actually texted you when it started in 2016. I remember texting you. So yeah, the reserve that has no reserves, exactly, Brock. Um, Malay, do you have suggestions on opinions? What opinions are better than others to invest in your super into? Um, I can't give that. A self-managed super fund gives you the freedom. It's none of these idiots. You've got all these idiots that are choosing where your money goes and the big Ponzi scheme that they invest in because they're told to and all that and regulated to. Having a self-managed super fund, you can invest it in whatever you wish it to be invested into. So yeah, if you'd like to talk about the options of a self-managed super fund, I can't give you that advice, but I can put you in contact with people that can. Flick us a DM, send us a message at admin@binvested.com.au saying super fund or something like that in the heading. Ask my team and they will put you in contact with the right people. Sam, question Nathan, once the mortgage is paid off, is it safe to leave the title with the bank? Or should I discharge the mortgage? I'm thinking there is a mortgage against the title. It might be better from fraud and asset protection. Yeah, I think leaving a small mortgage is safe with the banks. But in the world that we live in, who really knows, right? The reality of it is if you got a mortgage for $2,000 left on your property, they've got your title, it's all safe over there. If that bank went bust, your mortgage doesn't go bust and they take your house off you, that loan of $2,000 is sold. So someone pays for that loan and you can just pay it out and get the title from them anyway. So I think it's pretty safe. Adam said, thanks, mate. It's always a good watch. Thank you very much for watching and having me as a part of your viewing. Matt said, thanks for watching and thanks, mate. Michael, any info on the Vatican Bank recalling its assets from its parishes around the world by 30 September? Oh, surprise, surprise. That's what we're just talking about. It's interesting timing is all I can say. Rhett says, thanks, Birchie. Love the Tuesday night. Thanking you. Titles are now digital, so it's more paper titles. Paywall on links in Birchfeed. Yes. So if you find something that has a paywall on it, I don't subscribe to anything. So I'm not paying for shit when it's in Birchfeed. To get through that, there's a site called 12ft.io. So 12foot.io. 12ft.io. You go to that site, you take the link, copy it and paste it into there, push search, and it will remove the paywall for you. So just a little tip for everyone. Brett, surely Sydney and Melbourne are overcooked. Other cities and other regions is where it's at. Yeah. Look, I'm not looking at specific markets and saying what's good and what's not. I think that if you look at Gold Coast and Brisbane, I was buying in there when things were 30% of the value of what they are. And that was only 3 years ago. So looking at markets, there's areas in Sydney which I can pick up for $250,000. I've literally bought properties in the last month for my clients for 250, 260,000 in Sydney. Like 30 kilometers from the CBD in Sydney for 250K. If you go to the Gold Coast, you can't even find for that price anymore. So not even for one better. So there's opportunities out there in each capital city. I'll look for the asset and the value behind the asset. I'm not trying to time the market and go, okay, I'm going to outsmart the market. I'm just trying to buy good value assets in all different markets. Another great live session, mate. Thanks for your time and really appreciate it. Mate. Thanks a lot for tuning in. Stephen says, hey, mate, late to the party tonight, but I'll watch the video after. I hope you're doing great. I'm doing awesome. A little bit sick at the moment. got temperature, got a fever, got all those sort of things. So yeah, that's why I thought I'd start my holiday house and make the video instead of going to my office and making all my staff sick and all the people around me. Michael, your opinion on investing in gold and silver? I like gold and silver. I've been investing in it for over 20 years. One of my first investments was that. Problem with gold and silver is a lot of money has been made from that already. So yeah, a lot of money has been made from it. It doesn't bring in, is a very heavily manipulated market. Um, it doesn't bring a cash flow, um, but I do like it. So I wouldn't go and spend 50K and just put 50K in the cupboard. I would go and buy $1,000 this week and maybe $500 next month and 2 grand the month after and $100 a month after. Just add to it over time, and then yeah, it will all um, add up over time. So I'm a big fan of doing that. I haven't contributed to my super for the last 2 years. You think that's a good idea? I'm not a big fan of super. My dad carked at the age of 62, had a heart attack, never got to enjoy it and retire. I'm a big fan of living life on my own terms, doing what I want, when I want, how I want. I look at super as a bit of a bonus. I look at super as a vehicle for people, depending on what area that you're in life. I want to be enjoying my life for my life right now. The super is just, a bit of a bonus there. So I'm not an active person in wanting to put money in my super that I can potentially use it in the future. I utilize it as a tax vehicle. I utilize it as a vehicle when I've had to put money into it. And with that money, I've used that to buy assets and then be able to leverage myself from there. So it is good. Like if you have your money, most people have their money going into a super fund because I'm self-employed. I don't chuck it in there. I put it into other assets and I'm continuously growing. Um, so I pay myself a very little salary and I just reinvest my cash flow and capital constantly. So I'm not actively having to, do that stuff. So um, yeah, if you do have a super fund, you do want to find out more ways on how you can protect it, reach out to my team, admin at B.Invested.com.au, email us at call us at 1300 367 925. If you do want to book in a bit of a review session, my team, you've seen a few of my team members from time to time come onto these Tuesday night chats. There's a link somewhere in this description to book in a discovery session, just a 15-minute chat, talk about where you're at, what you need help with, and my team can put you in contact with the right people to help you on your journey. So click on the link, and tomorrow I have a webinar. Keep an eye out on our socials. Hopefully, I'm not too sick to do so. At this point, I should be fine. We're talking about building property portfolio and answering lots of common questions out there. So look forward to seeing you guys tomorrow night on the webinar. Thanks a lot for tuning in, and we'll catch up soon. Keep being awesome. Take advantage of the opportunities out there. Don't listen to the news. There's a lot of bullshit out there, and there's lots of opportunities, and it's a great time to be alive. You can see that these things are changing very, very rampantly, very, very rapidly. We're right on track. My view is that once we start seeing a change in monetary policy, they're going to have to re-stimulate the economy. That is going to cause the hyperinflation. It won't happen instantly. It might take 12 months, might take 2 years. It took 2 years of them printing money throughout the saga that we went through the last couple of years to really start seeing inflation occur. They're trying to stop that, but when they have to print it again, it might take 2 years for that to kick in. But it will be uncontrollable next time, and they're scared of it. They know that it's fucked. They know it's a Ponzi scheme, and it's a very, very fun to watch that because you can benefit big time from that. So make sure you don't look back in 5 years' time and or 10 years' time and go, wow, I really missed up on that opportunity. Take advantage of it. Catch up soon. Bye for now.